If the house always wins, shouldn't you just buy the house? Of course, that's not how it works. Welcome back to CasinoLove. This is the 5th episode in our series where we take a factual look at publicly traded companies in the iGaming space. Today, we are looking at Entain. As always, this is not a financial advice. We are not telling you what to buy, what to sell, or what to avoid. Our goal is simply to look at the company, understand what it does, and go through the latest official information. So first, what is Entain? Entain plc is a public company listed in London under the ticker ENT, and the company describes itself as one of the world's largest sports betting and gaming groups. It is in the FTSE 100, it operates in more than 30 markets, and across its official materials it presents itself as a large, diversified operator with more than 35 brands. This is important for viewers because Entain is not just one casino brand, and it is not just a background software supplier either. A lot of its business is directly consumer-facing. These are brands that players actually see and use, such as Ladbrokes, Coral, bwin, Sportingbet, Eurobet, BetCity, STS, Supersport, PartyPoker, Party Casino, Foxy Bingo, Gala, and the TAP partnership in New Zealand. At the same time, Entain also owns proprietary technology across its core product verticals and says it provides some B2B services to third parties as well. So in simple terms, Entain sits closer to Flutter than to a pure supplier model. It owns and operates many of the brands the customer interacts with, while also controlling a lot of the technology underneath. That mix matters when you look at the business. The company in its current form was built over many years through acquisitions, expansion, and rebranding. On Entain's official history page, you can trace the path from Gaming VC in 2004 to major deals such as Sportingbet in 2013, bwin Party in 2016, and Ladbrokes Coral in 2018. That same 2018 period is also when the BetMGM joint venture was created. Then in 2020, the group rebranded from GVC to Entain. In 2023, the company's history page lists milestones including the 25-year TAB New Zealand partnership, the BetCity acquisition, 365 scores, STS, and Angstrom. The same official history page also shows Stella David becoming permanent CEO in April 2025. That history matters because it explains why Entain today is such a broad portfolio company. It is not built around one single flagship brand. It is a collection of local and regional positions across sportsbook, casino, poker, bingo, retail betting, media, and technology. In its 2025 annual report materials and FY25 results commentary, management says approximately 98% of group revenue comes from markets that are growing, and over 87% comes from markets where Entain has a top 3 position. In the investor presentation, the company also says that in its 16 largest online markets, it has a podium position in 13 of them. That is a useful way to think about the company. Entain is not really a single country story. It has meaningful exposure to the UK and Ireland, Italy, Australia, Brazil, Central and Eastern Europe, New Zealand, Spain, Canada, Georgia, and the US through BetMGM. So when one market has a weaker quarter, the idea is that the broader portfolio can absorb some of that pressure. Now, let's move to the numbers. Entain reported its FY25 results on 5th of March 2026. For the Entain business itself, net gaming revenue, or NGR, was £5.32 billion, while reported revenue was £5.25 billion. Underlying EBITDA was £1.16 billion, up 8% on a constant currency basis. Online underlying EBITDA margin expanded to 25.7%. Adjusted cash flow came in at £151 million, which was ahead of expectations. Adjusted diluted earnings per share were 61.8 pence. Net debt at year-end was £3.64 billion, with reported leverage at 3.1 times and look-through leverage at 3.6 times. If you include Entain's 50% share of BetMGM, total group underlying EBITDA was £1.244 billion, up 28% on a constant currency basis. Total group NGR, including that 50% BetMGM share, was up 7% reported, or 8% at constant currency. Now, the other side of the story. Entain also reported a statutory loss after tax of £608.5 million. A major reason was an impairment charge related to higher UK gambling taxes that were announced in late 2025. The press release specifically points to a £488 million impairment related to those tax increases. Reuters, covering the results day, also reported that underlying profit came in stronger than expected, while the post-tax loss widened because of that UK tax hit. Management's main message was that the online business kept growing and that growth became broader across the portfolio. Entain said the FY25 online NGR excluding the US was up 5% reported, or 6% at constant currency. The company also said this marked 7 consecutive quarters of online growth. In the fourth quarter, online NGR was up 3% constant currency, even though sports results were more customer-friendly than a year earlier. In plain English, that means punters won more, which hurts operator margin. The UK and Ireland were one of the standout areas. Entain said UK and Ireland NGR was up 6% constant currency for the year, with UK and Ireland online up 15% constant currency, supported by double-digit volume growth and market share gains. Retail in that segment was down 2%, but flat on a like-for-like basis. International was more mixed. Brazil was down 1% constant currency, with strong volume growth offset by weaker sports margins in the second half and new taxes under the licensed regime. Australia was down 6% constant currency, again with customer-friendly sports results weighing on the top line. Italy was up 6% constant currency. Entain also highlighted double-digit online growth in markets including Georgia, Spain, Canada, Greece and New Zealand. Central and Eastern Europe also remained important. Entain said its CEE NGR was up 5% constant currency, with SuperSport and STS maintaining number 1 market positions in Croatia and Poland. On the cost side, management pointed to better operational execution, cost of sales improvement, better marketing returns, and efficiency work. In the results call, Stella David said Project Roamer had already delivered over £100 million in annual savings. The investor materials also show examples of AI-related workflow changes in marketing and product operations, although those are still company claims rather than third-party validation. For a lot of investors, BetMGM is one of the most important parts of the Entain story. BetMGM is the 50-50 joint venture between Entain and MGM Resorts in North America, and Entain says it provides the technology and capabilities that power the business, as well as exclusive games and products developed in-house. In FY25, BetMGM reported net revenue of $2.796 billion, up 33% year-over-year. Entain said that included growth of 63% in online sports and 24% in iGaming. BetMGM EBITDA was $220 million, which was a $464 million improvement year-over-year, and the venture distributed $270 million of cash to its parents in 2025. That matters because for years, BetMGM was mainly seen as investment phase story. In 2025, it moved into clear profitability and started sending cash back. Reuters also flagged BetMGM as a key support to the overall Entain story in its March 2026 results coverage. And there is another technical change from 2026 onwards. Entain's materials explain that cash coming back from BetMGM now has 2 parts. One is parent fees for licenses and services provided by Entain and MGM. The other is excess cash distribution above BetMGM's target unrestricted cash balance. Entain's investor presentation says BetMGM's policy is to keep around $100 million to $125 million of unrestricted cash, with excess cash sent to the parents on a quarterly basis. For 2026, BetMGM guidance is revenue of $3.1 billion to $3.2 billion and adjusted EBITDA of $300 million to $350 million, with management still pointing to a pathway to $500 million of adjusted EBITDA in 2027. Entain's appendix also says parent fees to Entain in 2026 are expected to be around $23 million to $35 million. The biggest near-term issue in the Entain story is the UK tax change. Entain says higher UK online gambling taxes are being implemented from 1st of April 2026. For 2026, the company expects online EBITDA margin to come down to 23 to 24%, and that already includes management expectations that it can offset about 25% of the tax impact in 2026. From 2026, management says it now expects to offset over 50% of the incremental UK tax burden through group-wide optimization work. In the official results commentary, Stella David said Entain sees this as a short-term challenge, but also as a possible long-term strategic opportunity, because larger operators may be better placed than smaller subscale competitors to absorb the pressure. Reuters highlighted the same point in its March 2026 coverage. That does not remove the risk. It just tells you how management is framing it. So, what is management guiding for now? For 2026, Entain expects online NGR growth excluding the US of 5 to 7% on a constant currency basis. Online EBITDA margin is guided to 23 to 24%. The company says total group EBITDA, including the US, should be broadly stable year-over-year, with the UK tax increase offsetting a lot of the underlying operational progress. It also reiterated confidence in generating at least £500 million of annual adjusted cash flow from 2028. That means the medium-term Entain case, at least as management presents it, rests on three big things: keeping online growth going, protecting margin through efficiency, and turning BetMGM from a growth asset into a cash contributor. If we put the stock chart on screen, the key point is not prediction. Reuters reported that Entain shares rose nearly 8% on 5th of March 2026 when the FY25 results were released, as investors reacted positively to the stronger profit number and the company's tax mitigation plan. But the stock has still been volatile. On the Entain investor site header and in the chart snapshot prepared for this video on 9th of April 2026, the share price shown was £535.20. So this is clearly still a name where the market is weighing both progress and risk at the same time. So what is the simple takeaway? Entain is a very large, very diversified betting and gaming operator. It owns many of the brands that players actually use. It also owns the technology stack behind much of that activity, and it has a major US asset through BetMGM. Its 2025 results showed real operational progress, especially online and especially in BetMGM. But at the same time, the business is now moving into a period where the UK tax pressure becomes a major factor in 2026. So for casino players, the interesting part is that you may already know Entain through Ladbrokes, Corol, bwin, Sportingbet, PartyPoker, BetMGM, or one of its other brands, even if the parent company name did not immediately ring a bell. And for traders or investors, the big things to watch are online growth, UK margin pressure, and how much cash BetMGM can keep sending back. And that is where we will leave it. Not a recommendation, not a financial advice. Just the company, the products, and the latest official facts.